Japan is now confronting one of the most dangerous economic moments in its modern history. A currency under pressure, a towering public debt load and rising geopolitical risk are colliding at the same time that China's financial influence is expanding and the global order is slowly shifting. In the decades after World War II, Japan was often held up as a model of stability, a disciplined society, world-class manufacturers, and a central bank that seemed to manage deflation and aging with technocratic calm. For years, that image looked accurate from the outside. But what looked like stability was also a kind of frozen equilibrium built on conditions that could not last forever. Japan's model depended on ultra-low interest rates, very low inflation, and a global trading system that let it import energy and raw materials cheaply while exporting high-value industrial goods around the world. That combination allowed Tokyo to carry far more public debt than any other major advanced economy without triggering a crisis. Today, that debt stands at roughly 240% of GDP, the highest among major developed countries. For a long time, markets accepted this as an exception they were willing to live with. Japan's own investors held most of the debt. Inflation was muted and the yen was seen as a safe haven. But once global conditions changed, particularly after 2020, the weaknesses underneath that equilibrium became harder to ignore. The yen has fallen sharply against the US dollar over the past 2 years, at one point losing around 10% of its value in a single year as the interest rate gap between the United States and Japan widened. A weaker yen makes Japanese exports more competitive, but it also makes imports, especially energy, much more expensive in local currency terms. For an economy that imports nearly all of its oil, gas and coal, that is an immediate squeeze on households and industry. At the same time, Japan's central bank has been boxed in by the very debt strategy that helped buy time in the past. The more debt the government issues, the more sensitive the system becomes to higher interest rates. If rates rise meaningfully, the cost of servicing that debt balloons, threatening the government's budget, heavily indebted firms and households that grew used to cheap credit. That is why, even as other central banks were lifting interest rates to fight inflation, the Bank of Japan kept its policy rate around zero and used yield curve control to cap longer-term borrowing costs. Analysts describe this as a kind of fiscal trap. The state must suppress yields to stay solvent, but suppressing yields puts pressure on the currency. One economist summarized the dilemma by noting that Japan now carries a debt burden exceeding twice the size of its entire economy. He said this is no longer just a financial statistic, it has become a strategic constraint. The higher the debt climbs, the less room policymakers have to respond to shocks, whether they are coming from energy markets, geopolitics, or financial stress. In that environment, every move the central bank makes sends a double signal, not just about inflation, but about the government's ability to manage such a large stock of debt over time. Markets are starting to price that risk. When investors grow nervous, they demand higher yields as compensation. But higher yields are exactly what Japan can least afford. So authorities repeatedly step in to buy bonds and push rates back down. That steady intervention can keep the immediate crisis at bay, but it also reinforces the perception that the yen will be sacrificed before the bond market is allowed to crack. As one analyst put it, its debt has become destiny, and destiny now points in a troubling direction. He said that as long as this structure remains, any shock, a spike in global energy prices, a new financial scare, or a geopolitical confrontation will hit Japan harder than it would have a decade ago. The domestic economic challenge, serious as it is, cannot be separated from Japan's strategic environment. Geography has always made Japan and China deeply entangled. They are neighbours, major trading partners, and increasingly strategic rivals. That rivalry has sharpened over questions like Taiwan, maritime boundaries, and advanced technology. For years, Japanese governments tried to manage this tension by combining quiet deterrence with economic pragmatism. Security ties with the United States were strengthened, but trade and investment with China continued to expand. That balance is now under strain. Japan's dependence on Chinese supply chains is structural, not marginal. Large parts of its industrial base rely on Chinese inputs, especially in advanced manufacturing. As one observer put it, Japan's modern industrial base, from automobiles to advanced electronics and high-efficiency magnets, relies heavily on Chinese refiners. He said this is most visible in the market for rare earth elements, materials that are essential for everything from electric motors and wind turbines to precision electronics and defense systems. Mining rare earths is one challenge, refining them at scale is another. Over the past 2 decades, China invested heavily in exactly that refining capacity and now controls about 90% of global rare earth processing and a large majority of magnet manufacturing. That gives Beijing a lever it has used before, tightening export controls on certain rare earth products or shifting to lower value forms that force foreign manufacturers to adjust their production plans. Analysts note that China has used these tools before, and each time it demonstrated an ability to apply economic pressure with precision that does not provoke outright conflict. They said Beijing does not need sweeping embargoes to make its point. Small, targeted changes in export licensing, customs inspections or quality rules can create uncertainty and raise costs for foreign firms that depend on Chinese processing. Tourism has become another point of pressure. Before the pandemic, Chinese visitors were a cornerstone of Japan's inbound tourism boom, spending more per person than most other nationalities and helping support regional economies. Recent diplomatic frictions have shown how quickly that flow can be disrupted. Hundreds of thousands of flight bookings from China to Japan have been cancelled, and travel agencies have scaled back group tours, raising fears of multi-trillion yen losses if tensions persist. From Beijing's perspective, these are calibrated signals. Japan's economic health is tied to maintaining a workable relationship with its largest neighbour. From Tokyo's perspective, they underscore a harsh reality. In a downturn, China can afford to lose more than Japan can. China's vast domestic market and deeper supply chain integration give it room to shift away from specific foreign suppliers. Japan, with a shrinking population and slower growth, has far less flexibility if access to Chinese markets is restricted. This asymmetry becomes even more significant against the backdrop of broader changes in global finance. For decades, the G7, led by the United States, sat at the core of the world's financial plumbing. Reserves were held in dollars and euros. Global safe assets were overwhelmingly Western government bonds. And crises were managed through institutions anchored in Washington and Brussels. That system has not vanished, but it is being slowly reshaped. In recent years, Chinese issuers, both sovereign and corporate, have stepped up their sales of US dollar-denominated bonds offshore, particularly through financial hubs such as Hong Kong. In 2024, international bond issuance by Chinese entities reached roughly $141 billion, with offshore US dollar issuance surging by more than 40% year on year. Recent sovereign dollar issues have drawn strong demand from global investors, including central banks and sovereign wealth funds, who see them as a way to diversify exposure while still holding assets in familiar currencies. One analyst described the effect this way: China has not overturned the system, but it has begun rewriting parts of it, and Japan, caught in the middle, lacks the leverage to shape the outcome. He said the architecture of global liquidity is becoming more multipolar. The dollar remains the dominant currency, but it is no longer the only pillar supporting cross-border funding. Western financial sanctions on Russia after the invasion of Ukraine accelerated this shift. Many governments, especially in the so-called global south, took note of how quickly reserves held in Western jurisdictions could be frozen. That experience encouraged a gradual diversification away from exclusive reliance on US and European assets. China, with its large economy and deepening bond markets, positioned itself as a partial alternative, a major power able to offer instruments in dollars, euros and renminbi through channels that sit partly outside Western legal reach. A key concept some strategists use to describe this is the Great Flip. He said this is the moment when a system designed to consolidate one group's power starts providing tools that another power can use for its own rise. Rather than building a separate financial universe from scratch, China has chosen to insert itself into existing structures, issuing bonds in Western currencies, listing them in offshore centres and selling them to investors already familiar with those markets. Over time, this strategy has led to what one observer calls the construction of a parallel liquidity network. In that person's words, China is building the scaffolding of an alternative liquidity ecosystem, one that does not replace the G7, but sits beside it, diffusing Western control and giving Beijing leverage in any future confrontation. He said that as more capital flows into Chinese-linked instruments, Beijing's ability to withstand external shocks grows, while the relative influence of traditional G7 bond markets subtly erodes. This does not mean the old system disappears. As analysts are careful to stress, the G7 still dominates global finance, but it now faces competition from a state that combines scale and geopolitical ambition. They said that competition matters at the margins, and in finance, the margins often determine who has leverage during a crisis. Taken together, these trends leave Japan in a particularly delicate position. On one side, it is a core member of the G7, deeply integrated into Western financial and security structures and dependent on the United States for its ultimate security umbrella. On the other side, it is geographically close to and economically intertwined with a China that is building new sources of financial influence and has clear tools to exert pressure on Japanese industry and tourism when relations sour. At home, Japan is wrestling with a classic impossible trinity of its own, trying to keep interest rates low to sustain its debt, maintain financial stability, and defend its currency, all in a world where those goals increasingly conflict. The authorities can tighten policy to support the yen, but that risks stress in the bond market and on indebted firms and households. Or they can prioritise domestic borrowers and fiscal sustainability, accepting a weaker currency and higher import-driven inflation. Either path carries real risks. Abroad, Tokyo has to calibrate its stance toward Beijing carefully. More explicit alignment with US efforts to counter China, for example, through statements about Taiwan or participation in new security groupings, may be politically popular in some Western capitals and consistent with Japan's own security concerns. But it also raises the likelihood that China will reach for the economic levers it has spent years constructing: rare earth controls, tourism curbs, regulatory slowdowns at ports, or subtle shifts in procurement toward domestic competitors. Supporters of a firmer line argue that Japan cannot ignore security threats and must signal clearly that coercion across the Taiwan Strait or in regional waters will have consequences. Critics counter that Japan is acting as if its bargaining position is stronger than it really is, underestimating its economic exposure while overestimating how far its allies can shield it from retaliation. For Japan's policymakers, none of these dilemmas has an easy solution. The structural issues, demographic decline, persistent low growth, high public debt, and deep trade interdependence with China cannot be reversed quickly. The question is less about finding a perfect strategy than about managing risk in a world where cushions are thinner and shocks more frequent. The story unfolding in Tokyo is therefore about more than one country's currency or bond market. It is a window into the way power is shifting in the 21st century global economy. As the financial order becomes more fragmented and multiple centres of liquidity emerge, the advantages once enjoyed by long-standing powers are eroding at the edges. In that environment, states that misread the balance of power, whether by over-relying on debt, underestimating economic dependence, or assuming allies can offset domestic vulnerabilities, may find themselves with fewer options when the next crisis arrives. Japan's experience shows how quickly a reputation for stability can give way to questions about resilience. It also highlights how deeply economics and geopolitics are now intertwined. Exchange rates, bond yields, export controls, and tourism flows have become tools in a broader contest over influence. Whether Japan can navigate this period without a deeper shock will depend on choices made in Tokyo, Washington and Beijing, and on how the global system absorbs the continuing rise of China as both an economic and financial power. What is clear already is that the era in which one bloc could dictate the rules of global finance unchallenged is ending. A more complex multipolar order is taking shape, and countries like Japan, caught between aging domestic structures and a changing external landscape, will have to adapt more quickly than ever before.